Hello everybody, this is Luke Myers. I want to make a quick training video here. I've been doing some data mining on my day trading that I've been doing, and I've been holding for about the past 3 weeks or so. I've been holding about a 60% win rate. Knew there was higher potential for at least 2/3, 66 to 70% win rate. Was getting hicked up on a couple patterns. In the past week, I haven't been doing so good for a number of reasons, but part of the past few days I've been getting mixed up in some bad patterns, and I just today, after doing some careful analysis, record keeping, data mining over the charts, I found I solved the problem. So I wanted to quickly share that, basically what I've been working on, what I found. Today is the 1st of May, anyway, real briefly, this is my system. It's on the tick charts, the S&P E-mini. You can see here it's 512 tick. What I did is I marked up all the areas that are winning trades according to my pattern, and then losing trades. So basically, what you see here, this big bar, is market open from the morning session, the time that I trade. The circles are winning trades and the squares are losing trades. What I call when this is a 50-period moving average channel, and I trade swings on this, the red line is a 200-period EMA. What I discovered was anytime that this channel is touching the 200-period EMA, do not take any trades. It's very low probability. I call this pattern entanglement. It's best to avoid it at all costs. I've been trading the pattern for a few weeks now, and I have been noticing that it's been providing a significant part of my losses. After doing some more careful study, I found out that at least in the past week, it's only had about a 20% win rate. Not only that, but there's a lot of fake outs for dip pops. You see this right here. I actually got suckered into this thinking it was a dip pop, because I saw this downtrend thinking it was going to go back down, and then got stopped out. It broke higher and then went long. Got stopped out twice. I was done for the day. I had no possibility of getting either of these two trades. Actually, either of these two trades originally would have been hard for me to take, because I wouldn't have known about the momentum here, thinking it was too bullish. But you can see I've smoothed out the momentum. I'm using the slower 26-period moving average for momentum instead of the 12. I find it to give a more accurate reading. But more importantly, price action. What happened here is the price cracked to a new low. You can see this was the prior low. It broke to a new low. Not only that, but the 50 crossed below the 200, and it did it for the first time, indicating a new downtrend. The first pullback in such an event, at least in the data that I've been recording, has a 70% probability rate, just taking on price action alone. If you use it with momentum, you can increase that maybe near 75 or near 80% just on this pattern. So if you avoid this entanglement, I could have completely avoided this, wait for price to crack in one direction. You can see it cracks down, cracks to a new low. I know I'm good to go in for a short trade. Momentum's here is breaking to a new low. It's past, confirming all of this, and we take a short trade. Now you could say, well, it didn't go down past this. That's not the point. The point is that price did, and it's on a fresh new low from where it was in this old trend, from where it was above the zero line. You can see that there was dips. This is what you want to go off of. You don't want to use momentum that's too old. Momentum is a short-term indicator. Immediate momentum is most important. And then we can see we dipped down, would have hit my profit target. You can see bullish price came in. No reason to take a second trade. Stay out of the market. It rises. Weak kind of marginal trade. I know some people that took this. I didn't take it. Anyway, it popped up, bearish momentum, stay out, and then it goes sideways for the rest of the day. If we continue on, we'll go on to the next day. There would have been, early in the morning, there would have been a fake, we call this a dip pop. It's where there's, bearish momentum. It doesn't actually look bearish, but the price is bearish here. It hits the 200 and then pops up. Generally, those are high probability. This one failed. Broke to a new low, but if you would have taken this short, you would have been stopped out. We had 2 stop outs here. But knowing that this is an entanglement because it's inside these bands, you avoid it, and then you can get a dip pop because it pops back up. Also, you look at momentum, didn't make a new low. That's a bullish sign. It keeps on rising. You can see here it goes up to a new high, pulls back, you get in, pulls to a new high. If you played this right, you could have got 3 wins. Very good. Afternoon, you potentially have a couple of trades, potentially one dip pop and potentially one dip pop here, and then potentially you can see it cross the 200 for a new, I call this the first swing pattern. It's a first swing touch of a new trend. A new trend is defined as a fresh cross of the 200 EMA and the 50 EMA, fresh golden cross we'll call it. Then you can see kind of battles around here to end of day, typical. Following day, we come in, and actually this square here is the morning session. This was a fresh cross, would have stopped you out. If you look here, you can see there was a support area. You come up here, it stops you out. This is actually a very choppy day. This would have been generally just a losing day. Would have been tough until you had this fresh cross in the afternoon, one potential winner if you waited all day. Next day was good. We had a nice winning dip pop here. And then momentum broke higher, and we got another pullback, and then had 2 wins. Afternoon, there was one more play. Next morning, this was the day I really started to hone in on this, identifying this entanglement pattern. I was using a different trading screen, and it was really zoomed in, and I didn't know I wasn't as far out as this, and I thought what I thought was a dip pop here. I thought it was more significant than it was. I didn't realize it was such a minor little pop. It's one of the dangers of being too close. When you're trading, it can be very dangerous to be too zoomed in on your screen. It's better to be a little bit farther away so you can have a better view of what's actually happening. And what happened was I saw price was under the 200 EMA, trending down. I saw that it was fighting to try to break out here. It broke down, and I was so eager to get into a trade I went short, thinking it was a dip pop, and it was just a fluctuation, which I was unable to see because I was so zoomed in. Broke up. I figured, well, my dip pop failed. It must be bullish. Momentum looked like it was breaking out because it was higher here, and then it failed. I got 2 stop outs. I was done for the day. I had no option to make any money. It was really frustrating. But what I learned was to avoid these types of patterns. This is entanglement. This is where the 50 EMA channel is touching the 200. You want a clear break. Eventually we did get a clear break, as you saw earlier in the week. Broke down to a fresh new low, took the first swing, boom, made some money. Now you could have took the second swing, but I don't take this because there's bullish momentum here. Eventually it does kind of break down and kind of fight on, and eventually it does pull up. Pulls up strong, very strong, and a new trend is formed. You would have taken that first new trend, boom, you had another win. So you would have had 2 trades, 100% winners versus 2 losers, just by following this simple pattern system. Very good. We go on to the afternoon, gets a little choppy, potentially 1 loss, 1 trade. Typical of the afternoons, kind of slow. You're going to make most of your money in the morning just because that's where all the volume and activity is. Anyway, this is the next morning session. This is actually today. There was this was a tight one. It spiked out quite high. You could have got stopped out here. What you'll see is you'll see this blue line. There is kind of like a little dip. I actually didn't take this trade because I was just using the more sensitive algorithm line, and it looked bullish to me. And now I smoothed it out. When I see something like this, I call that micro momentum. And you're still breaking a new lows. You're still within your high probability pattern because it's a fresh cross. It's a first swing pullback and a fresh cross. But because there is a little bit of bullishness here, instead of being right at the moving average line, you want to be a tick behind it. Now, if you would have been a tick behind it, you wouldn't have been stopped out, you would have been safe, and you would have been good for 2 points. Anyway, you can see here, it tried to break out, it double topped, it failed, but then it got bullish. It got entangled, and by then the morning session was over. It stayed flat for like an hour in entanglement. Afternoon came, it pulled down again, broke to a fresh new low. We got a swing. I did actually take this, although on smaller size, just because I don't typically take afternoon trades. That did work out. And then it got bullish again and got entangled. Same pattern. Entangled, broke lower. So breakouts from periods of entanglement are high probability, especially if they break to a new high or to a new low. Very, very important. And especially if they break out from entanglement to a new high or to a new low, and there hasn't been a pullback, and you're taking the first pullback after this new high or new low has been made. Clearly 70+% win ratio. You can make a very good living just hunting for this pattern, just being patient, waiting for it to appear. So that's what I'm going to be doing. That's what I'm focusing on. And I'm avoiding this entanglement now, staying with momentum, staying on the side of the trend, always willing to take the first swing pullback of a new trade, and also willing to take a second pullback, provided momentum is still strong. You can see here we had a fresh low in price. If you come down here to momentum did not make a new low. Now, if momentum also made a new low, that would be telling you the momentum was strong. You could take a second trade. Now, if it bounced, say momentum was bullish, it hit the 200 and then crashed down again, making a new low here, and then it swung, I would consider that a dip pop pattern, provided it wasn't entangled like it is here. That's a very sign of strength, and you're expecting a breakout. So you don't want to take any swings. You want to see more continuation. If it fails, then you're looking for a new fresh low. So anyway, these patterns happen about once a day, at least in the morning session. Some days they don't, but they happen at least once a day. If you don't get one of those, you usually have a nice strong trend, and you can get a couple of dip pop patterns, or at least one of these patterns with a strong trend. Anyway, this is Luke Myers signing out, and take care.